This is the final day of September and the final day of the quarter. And boy, the bulls are glad to see this September go. It looks like this is going to be the worst month for the stock market in terms of the S&P 500 since early 2020. Let's talk markets with Jacob Walthour. He's the CEO of Blueprint Capital Advisors. So thank you for joining us, Jacob.
Thank you, Conway. Good to be with you again, and thanks for having me on.
Great. Listen, we're seeing the market fall, excluding the Nasdaq. Really, the Dow down like some 400 points on this day. This is the final day of the month, final day of the quarter. What happened to the window dressing?
Yeah, we're not seeing window dressing at the end of this quarter, and window dressing is really all about professional portfolio managers looking good for their investors, and that means they're going to sell their losers and migrate capital towards their winners. And so it looks like from a portfolio perspective, the portfolio is better positioned going forward, and hopefully that leads into the retention of those investors. I think this time around, um, portfolio managers are paralyzed. They're not really sure how to interpret what I'll view as conflicting data. I think overall, people are staying invested, which means they have a long-term bullish sentiment on the market. But I think short-term, they're looking at this data. Let's take, for example, initial jobless claims. That number came out today higher than expected. Now you have to ask yourself, with record high job openings, and I think that number is hovering around 10 million, and roughly 750,000 jobs being added to the economy in the US over the course of the last 3 months, why do we have an uptick in initial unemployment claims? Especially given the fact that all of the assistance in the form of enhanced unemployment benefits coming out of Washington have ended. And so when they're trying to interpret that kind of data, it doesn't necessarily give you enough direction in terms of which sectors or which companies you should favor and which ones you should de-emphasize on a going forward basis. I think in the backdrop of all that, you also have another round of dysfunction in Washington. Here we are talking about another shutdown, on the part of government. We're trying to raise the debt ceiling or at least have a temporary solution here to avert a shutdown. The Fed is talking about tapering, which means, sooner or later we're going to talk about, raising interest rates, and that cascades through in a form of higher borrowing costs. So I think with all of that data out there, basically it's going to take next month's earnings season to stabilize the market and get people excited again about a broad recovery at the company level.
So as you know, I like to talk strategy with you. So let's talk strategy. Last time I had you on in April, you said that you were bullish on the banks shorter term, but you were concerned about the financial sector longer term. So now here we are 6 months later, and I'm wondering how you're feeling about the financial sector, especially given the fact that now we have interest rates finally moving up, but it seems like fintech is coming on pretty hard.
Yeah, fintech is coming on strong. I was constructive on the banks about 6 months ago. And there, what I was looking for was more of a cyclical recovery. From a long-term perspective, I expressed my concerns, and I'll be completely honest with you. While I think the banks are very healthy from a balance sheet perspective, while I think they're starting to put more loans on their book, and certainly higher interest rates will lead to better margins on the part of the banks, I just think they're boring. And I don't have any high expectations that having them in a portfolio is going to lead to above average results. And so while I think that they're healthy, I just don't think that they're the best play right now if you're putting fresh money to work in your portfolio. I do think there are other financials that are much more interesting to me. So, for example, MasterCard and Visa. We're coming into the holiday season, and I fully expect that people will be shopping remotely and using their cards, and that obviously is going to benefit MasterCard and Visa. And so if I'm looking at financials right now, I'm probably favoring situations like those over the big banks.
And real quick, talk to me about technology. When I had you on in April, you said that you were looking for a benign correction and that you were going to do some buying. We got the Nasdaq down about 5% this month. Is that enough of a benign correction? And what are you buying?
Sure. So let me just be really clear. whenever money comes in, that money should be directed towards companies that you think are disruptive, companies that you think are sustainable, companies that are dominating their industry, and quite frankly, companies who are changing industries. And so for that reason, even if there weren't a benign correction right now of 5% over the course of the last month, I would still be excited about large cap tech names. But having said that, there's nothing wrong with buying them at a 5% discount. I think 5% is enough. I don't think there's anything in those companies' operating situations. They're not experiencing their own little private bear markets. And so I happen to think that the marketplace is giving you a 5% better entry point for a lot of those big tech names. And in some of those names, you're actually getting a much larger entry point. So I continue to be bullish on tech. I probably will be continuing sort of my bullish stance on tech throughout 2022. And when I'm venturing from tech, I'm looking at companies who are being more tech enabled. And so I like Lowe's, I like Home Depot. I think they've done a good job of converting their business models from being big box to now offering more of an online opportunity. I continue to be super excited about Amazon as we come into the Christmas season. I just don't see people with the spread of the Delta variant taking that risk, going back into malls. I think they do most of their shopping online, which obviously benefits Amazon and other people who have done a really good job of e-tailing. So over the course of the last 6 months, not much has changed from my perspective. I'm still very, very positive on the overall market and still, as positive on my tech names.
All right, great. That's Jacob Walthour. He is the CEO of Blueprint Capital Advisors. I'm Conway G. Gittins, and this is Reuters.